The bulk of big tech earnings are behind us, with just Snap left to report this week. Apple investors are breathing a sigh of relief, but the Nasdaq Composite lost as much as 4.2% since its July 25th high as investors sold shares of Facebook, Netflix, and more. And Morgan Stanley is now arguing this is just the start of a bigger sell-off in U.S. equities driven by tech. The bank recommended selling U.S. tech stocks a month ago and now says traders are starting to heed their bearish call. Joining us now to discuss from Washington, JMP Managing Director Ron Josey in New York and Bloomberg TV's markets editor Romaine Bostick. Romaine, I'll start with you. What is Morgan Stanley saying here? What's the argument?
Well, I mean, their argument is really one based on one, valuations, but also just the growth that we've seen out of these stocks. I mean, Morgan Stanley's been banging this drum for a while now. And, you know, I should point out a lot of people have sort of called the end to the tech rally several times this year. And the tech stocks continue to sort of find another leg up. It's certainly possible that we could have reached a peak. There are other analysts other than those at Morgan Stanley, other strategists, I should say, including over at Oppenheimer, that are also making similar calls and recommending that folks look to other areas. But, you know, at the end of the day, we had a very good earnings quarter. And the question is whether they can repeat that come the third quarter.
Ron, you cover Amazon, Alphabet, Facebook. Would you agree with Morgan Stanley's assessment here?
Well, I think there's definitely a lot more uncertainty in terms of the cost side, in terms of all the debate going on with security and privacy and whatnot. But when you look across, at least I cover the internet sector, so when you look across the sectors in technology, when you see the secular growth that's continuing here, it's hard to say that, you know, tech doesn't have continued upside. When I say tech, I guess I mean Google and Facebook and Amazon and others. Specifically, online advertising continues to be extremely strong from our perspective. Usage and engagement suggests they continues across the space, and frankly, you know, Facebook, Amazon, Google, and others are just continue to innovate in their products. So it seems to me that there's a lot of secular growth that can continue.
Let's talk about Facebook specifically, because I believe you lowered your target there, but you're still optimistic. Why? Yeah,
I mean, we lowered our target simply just given the increased risk around the guidance they gave, risk around increased costs, especially, you know, around privacy and security. But frankly, when talking to advertisers, when thinking about the product, we think the product is awfully sticky. We don't think engagement on core Facebook is going to materially deteriorate. And if it does, we think Instagram is a big winner there. And specifically, when it comes to the monetization of it all, yes, Facebook is trying new things around perhaps showing stories more often in your news feed and what have you. But when you talk to advertisers, Facebook still has the best targeting capabilities out there, bar none. And until that changes, I think they're going to continue to see an influx of more dollars coming online.
Okay, but what about their credibility? I mean, there's this new story out today about Facebook reportedly requesting information about users, financial information from banks. You know, Facebook has said that they're not actually asking for data, but, you know, these products investors are optimistic about. But this credibility cloud seems to be hanging over the company, and I wonder when that goes away.
Well, I do think internally they have prioritized privacy and security across most any other investment that they're doing. And, you know, when you see stories like this about potentially integrating someone's checking account into Facebook, it seems a little bit of a stretch, at least for now. So frankly, I sort of go back to the checks that we're doing and talking to the company that security, privacy seems to be number one. If they do start working more closely with financial transactions, perhaps that's more towards their e-commerce and what they call their marketplace business. But I think that's very early days. And so I guess I don't believe that this integration that we're talking about with banks, where you can see maybe all the data, I have a hard time believing that's gonna happen here soon.
Now, Romaine, despite all the hype, tech actually hasn't been the leader in this market for the last couple of months.
No.
Who's been the leader?
There's been quite a rotation. In fact, I mean, if you look at the Nasdaq Composite, the most interesting thing is the two leaders have actually been insurance and then healthcare, basically the biotechs. And then even if you break down some of the S&P sectors, again, you know, tech sort of falls down into maybe like fifth place if you measure from the end of June. And this is partly what a lot of analysts are saying. And Ron kind of touched on this. It's just the idea, not many of these analysts and strategists are saying that these stocks are going to sort of take a dive, but they're saying relative to other sectors, given how high value they are, that there might be time to sort of rotate elsewhere. There's also a lot of macro trends with folks rotating into some of these more defensive sectors. And if you're in these tech stocks right now, there's a call by some of these analysts that you might want to protect yourself given that rotation.
Now, I do have a chart here in my GTV library showing the weight of the FANG stocks in the S&P. You see a dip at the end, which occurred on the back of Facebook earnings. Meantime, Ron, Amazon has been one of the factors in this market that's been driving it up. And you raised your target on Amazon, and you say you're confident the company will continue to take wallet share. Why?
Yeah, so just first on maybe the prior commentary, I think at the end of the day, it's results that's going to drive multiples higher and the stocks higher. And frankly, when you look across Facebook and Google and Amazon and many, many others, I think you still see a lot of tailwinds around the secular shift. And from Amazon in particular, Emily, it's actually fascinating. They continue to drive very strong top line growth. And yes, Whole Foods helps there for now until you start comping that. But the core marketplace is doing extremely well. On top of AWS seeing accelerating growth, their advertising business is something that's just beginning. And the fascinating thing about advertising is the more you advertise on Amazon, the more probability that your products show up higher in natural search results on Amazon. So it could be, the more you advertise it, the better it is overall. And so when we think about all these names and the stocks and where they could go, it seems to me, at least from a profitability perspective, Amazon has more upside than perhaps what are in targets today. And I'd argue that might be the same for Facebook and Google over the long term for sure.
And what about Alphabet? Alphabet's positive earnings were rather a surprise. It seems you're maintaining your optimism there. There's this controversy about the company trying to get back into China, which obviously is a huge potential market, but certainly riddled with, it's a minefield, in fact.
Yeah.
What are you watching for when it comes to Alphabet? What are the specific trends that you're excited about and concerned about?
Yeah, I mean, actually looking across maybe the top large caps in the internet space, I'd say Google, Alphabet produced one of the strongest quarters across the space. And one of the reasons is you're seeing 26% growth or maybe 23% growth ex-TAC on the top line for net revenue on their core advertising business. And the key there is perhaps we're entering a new phase within their advertising and search where AI and ML is a lot more integrated in everything that you do. And if that's the case, then maybe that attracts more advertisers to basically more advertisers on the platform that then advertise more. So we come out of this earnings cycle with the large caps, largely reported and feeling very strong about where Google can go with AI and ML being more incorporated in their core ad product. Remember, Emily, a few weeks ago, or actually mid-July, they revamped their ad product not too long ago. So there's a lot going on here on Google that's interesting. The China stuff, we'll have to see what happens. I remember when they pulled out 8 years ago or more, and I think we'll have to see what happens there because it definitely is a different market for sure.
I remember as well. I was in Beijing covering China at the time, and it was huge. It was a huge exit. Romaine, what are you going to be watching for over the second half of the year for signals?
Well, I have to tell you, I mean, it feels like there's a little bit of a rotation even within the tech sector. When you look at the earnings that we had that just passed, I mean, it really wasn't the internet companies that folks got enthused about. It was a lot in the semiconductor space and even in the hardware space. I mean, we talk about 27% year-over-year EPS growth for tech as a whole, but you have 52% for the semiconductors and something like 30+% for hardware. And then when you look at the market reaction that we had for a lot of these internet stocks, it was among the lowest when you measure it by sectors. It just really wasn't there. So it's not so much that these companies aren't growing, but it's that they have reached a sort of a maturation phase in the eyes of a lot of market participants, and they're looking for yield elsewhere. And if they can find it in some of the more, I guess, middle cap type of tech stocks, that's where they're going. It'll be interesting to see what type of catalysts we can get going forth from these big behemoths like Apple and Alphabet, but they've got to show what the next product is or the next service is that's going to justify the valuations that they're at right now.